Good morning, everybody. I'm Steve Jones, one of the managing partners of Foothills Wealth Management, and we welcome you to our market update today. First of all, let me tell you that we're all working remotely, so we're trying to do this best we can. But if you hear dogs barking or children yelling or doors slamming, just forgive us for that. We'll do the best we can do today. Foothills Wealth Management is an in-depth financial planning and related financial services firm. We've got 3 licensed investment advisors, 2 holding the CFP designation, Certified Financial Planner. We also have a licensed paraplanner on staff, and on the call with me today are my partners, Rusty Bynum and Will Jones. Also on the call with us is Josh Bartholomew and Austin Fitch with Horizon Investments. Excuse me. Horizon's a world-class money management firm located in Charlotte. We've had a long-term relationship with them. They manage, I think, Josh, a little over $6 billion, correct?
That's right, yep.
And Josh runs the consulting practice arm of the firm, and we partnered with them 2 years ago, and they now sit on our investment committee. And Austin is a CFA, financial analyst, and we all know what analysts do. They get in the weeds, basically, and that's what we're going to do today, is get in the weeds with Austin. Rusty, Will, and I are going to ask some questions, and hopefully he'll be able to give us some insight. With that, Josh, I'm going to flip it over to you for a minute.
Steve, thanks so much, and Steve and Will and Rusty and all of you on the phone, just grateful to have some time together with you. We're just so pleased with our partnership with Foothills Wealth Management and with the work that we do with your investment committee. I mean, I think, Steve, we've known each other for the better part of a decade. So it's just great to work with people that you have long-term relationships with. And really, as a firm at Horizon in Charlotte, what we're focused on is bringing in intellectual capital, putting together resources that investment committees like at Foothills can tap into for broader perspective, for ideas, idea generation, and just looking at global capital markets from an in-depth perspective. I think our team kind of covers the gamut, whether it's economic or fundamental or more technical or quantitative ways to look at global capital markets. That's what we do. But we try to help customize that research based on the investment committees we serve. And so I know Steve and Will and Rusty, you guys are really driving force behind what happens from an investment perspective, and we're trying to support that with research. And so my colleague with me is Austin Fitch. He's my right-hand man on the investment side, on the analyst side. He's a senior analyst for us, been with us for quite a long time at Horizon Investments, and he and I really run the consulting practice, working with individual investment committees, just a few of them around the country, and he drives that research process. So Austin, we thought we'd kick it off with you just to talk about markets in general. I mean, I know these guys have tons of questions to ask in terms of things that clients are asking them, but maybe give us a high-level 5-minute kind of overview as to where we are. So much has happened in the last, 8 weeks or so. We'd like to hear your perspective.
Yeah, no, Josh, it's definitely an interesting place. And guys, thanks so much for having me on this morning. I think, though, Josh, what I would tell you is it's probably most important if we're really trying to get a landscape to think back even to the end of 2019 and just kind of where we came from before we entered this entire kind of situation that we're in currently. Remember back to the end of 2019, we were coming off a pretty historic year from a market perspective. And that was, I would say that was actually probably pretty reasonable from where we stood from an economy perspective. You had very strong economic data. You had very strong consumer confidence. You had really the biggest question outstanding was the trade war. And it appeared as we got towards the end of 2019, the beginning of 2020, that was really going to be solved. And so the risks were starting to come off the table that we had maybe even been thinking about in 2019. Obviously, there were a few risks as we entered 2020. This being a presidential election year was one that was fresh on everybody's mind. especially the first couple months of the year, especially as we headed into Super Tuesday there, the first Tuesday of March. You obviously had lots of conversation about who was going to be the Democratic nominee, how that nominee was going to stack up against President Trump in terms of the general election as we got into the fall. And that was really what the market was looking at from a risk standpoint. You started to have a little bit of oil volatility as you got into February, so that contributed. But realistically, I would tell you the market volatility obviously started to really kick off once the coronavirus or COVID-19 really came to the forefront. And that happened really as you got into late February and early March. And obviously then you see what has happened both from a market perspective, but also from an economy's perspective. For that matter, just from a daily life perspective for all of us, obviously doing this call remotely, as Steve mentioned earlier, really puts us in a very unique position. I think some of the questions that we'll get into today will kind of drive into where we see markets going from here, obviously coming off the back of really one of the most volatile times in market history. And that's saying a lot, considering that that goes back, nearly 100 years, if you think about kind of modern day markets. So it's definitely been volatile, both to the up and the down. We'll talk about that. But what I would tell you is the strength of the economy coming into this is actually a good thing. And we think as we continue the conversation about where we're going, hopefully that is a positive on the way out of this thing as we get later into 2020.
Great, thank you. Going back to just market update data, Austin, can you give us some current market performance numbers, year-to-date Dow, S&P, NASDAQ, et cetera,
Yeah.
maybe 19 versus 20 so far?
Yeah, no, absolutely. And I think, Steve, to your point, it's great to look at 19 because, again, I think that paints a picture of where we came from. 2019 was a year when the S&P was up roughly 29%. The NASDAQ, which is going to be a little bit more technology focused, was up 40%. You had the Dow, which is going to be your larger, more traditional companies. I mean, that was up more than 20%, roughly 22%. So you had a year which was really strong from a market performance standpoint. Fast forward into the first quarter of 2020, and you had losses really across the board of 30, 35, in some cases pushing 40% across many of those major indices. So if you think about the S&P 500, it was down almost 34% from the middle of February until the middle of March. And again, I think the thing to realize is just the speed at which that sell off or drawdown occurred. So that's something to keep in mind in terms of that, that period. What I would tell you is year to date, you've actually seen a pretty good bounce back in really broadly speaking from the bottoms that we did hit. But year to date, you're looking at, the S&P is only down about 9 or 10%. So well off the lows that we hit in mid-March. Now, that's not to say that it's only going to continue to go up, but that's kind of where we sit today. I would tell you some of your more traditional, think of the Dow Jones, those types of companies are maybe not as, haven't bounced back as much, still down about 15% a year to date. International stocks are maybe marginally worse, down 18 to 20%, depending on the region or the area of the world. So you're still seeing a substantial, downturn year to date, but it's, I would tell you, much better than where we were maybe a month and a half or so ago now, almost 2 months.
And we look at that bounce back, though, is it just a narrow band of stocks that are driving that? Is it mainly technology, healthcare related, those type things? I mean, it's not so much the broad index.
Yeah, no, I think you're absolutely right on that. And that makes, if you look at like the NASDAQ, for example, which again is going to be more technology focused, has a little bit more healthcare, that index itself is actually positive on the year, which I think Steve highlights kind of what you're getting at is there have been very specific areas of the market that have bounced back much stronger. Some of those are some of your larger, more technology-focused companies. We'll talk about, I'm sure, later on as we get into maybe opportunities going forward. But I would tell you that the technologies and the healthcare companies of the world, really, those have bounced back much stronger than maybe your consumer staples, if you will, or your discretionary, your restaurants, if you want to think of it that way, or your hotels or your cruise lines, obviously, companies that have been much more affected by the economic shutdown than maybe a technology company.
Yeah, so what was the actual lowest point of the market today?
Yeah, so you're looking at lows really hit right around March 23rd. It kind of varies by a day or two depending on the individual index, but March 23rd generally was that market bottom that we've experienced currently. And again, if you look at kind of where we came from the peak, the market highs, if you will, that we hit in mid-February, you were off 35 to 40%, really across the board over the course of about 20, I think it was 22 or 24 market days.
Wow, yeah.
On top of that question, I guess now that we've had such a large bounce back from that date, do we see, another pullback or a substantial leg down coming in the market?
Yeah, I mean, I think, Will, the way that we're looking at it is there's definitely the possibility that you have some additional downside. I think right now, and you've seen it really for about the last month or so, that we've been in kind of this sideways kind of choppy market. We really haven't gone anywhere. If you look really over the last month, and now maybe it feels like things have gotten better relative to where we were in the middle of March. But realistically, things have not changed substantially over the last month. And I think that paints a picture for going forward of the possibility that you could very easily break out to the upside, but you could also break out to the downside and retest those lows or take another leg down, as you mentioned. And I think that's, I would say, entirely dependent in a sense on really what kind of comes of the virus itself. And what I mean by that is if you're looking at the data that's coming out around the virus, do you start to see more and more positive data? And that's in regards to testing capacity. That's in regards to hospital surge capacity, maybe the progress towards a vaccine or a treatment plan. If you get positive data along those lines, I think you very easily could see markets go higher from here. On the flip side, and I think, unfortunately, I would say the market optimism is probably leaning towards a solution being figured out. So the market's maybe leaning that way in terms of expectations, but you could very easily see some of that data come out, and maybe you start to see a second wave, if you will, of the virus. You start to see maybe testing capacity isn't where we need it or want it to be. Maybe progress towards a vaccine or a treatment doesn't happen the way that maybe we would all hope that it would. And that type of data is really the risk to a potential downside as we look out into the second half of 2020.
Hey, Austin, if I could just follow up on that, though, it just seems like in the last month or so, we've been in this range. We've gotten away from these wild swings. And I guess the good news there is it seems like there's less unknown than we had before. And now we sort of hover in this range until there is new news, but there's a lot less unknown. Would you agree with that?
Yeah, I think that's a great way to put it, Josh. And really, if you think about markets in general, what I would tell you is markets can deal with risk. And risk is something that we talked about earlier, maybe the presidential election or maybe oil price volatility. And the thought being that risk can be quantified. You can put some sort of probability around risk, the probability that it's going to happen or not going to happen. And markets can deal with risk. Now, that's not to say that it's always going to be a good outcome, but markets can price in risk in a sense. Josh, to your point, uncertainty is a very different picture, and that's what we got really at the beginning of March around this virus. There was so much uncertainty and unknown I think if I were to quote Donald Rumsfeld following 9/11, it's the unknown unknowns that really kind of pose a challenge for the markets, because they don't know, obviously, what they don't even know at that point. And that's the challenge. So what I would tell you is part of the reason that you've seen this range that you referred to, where the market really hasn't gone up or down significantly over the last month, is you haven't seen these wild moves because the uncertainty is starting to come off the table in terms of we're getting more data, we're getting more information. And that's part of the reason the market maybe is at least a little bit more optimistic today than it was a month ago. Now, again, that doesn't necessarily mean that things are automatically going to get better, but you're not getting those wild swings because you don't have as much uncertainty. Now, all that potentially goes out the window if you get a second wave. You get the possibility that maybe you don't develop immunity to this type of virus. Those are the types of things, Will, that we would be watching for talking about a next leg down or another leg down later this year. Those are the types of risks to that possibility.
Right. Another big question we seem to be getting is, the last time we had a substantial market drawdown like this was 2008. So the question is, what is different now versus 2008?
Yeah, I think there are a couple main points that I would hit. First and foremost is kind of what I was saying earlier about coming into this environment. The U.S. economy was actually much healthier than it was in 2008. If you think about 2008, we were really kind of in that real estate bubble that was leading to that. And really that started to pop late in 2007. So you started to see weakness in the U.S. economy really much earlier than you experienced kind of the market sell-off that we all experienced late in 08, beginning of 09. So that's the first piece. Again, the underlying economic data coming into this was very, very strong. So we've got that as hopefully a tailwind on the way out of it. But the other thing that's different from 2008 is just the speed and the magnitude of the event itself, and from a market standpoint. I referenced earlier, really from the middle of February to the middle of March, you had a sell-off of historic proportions, and unprecedented is maybe a fair word to use there. Where again, as I mentioned, you were down roughly 35% over the course of 20, depending on the index, 20 to 24 market days. To put that in perspective, peak to trough or market high to market low in 2008 took over a year. And maybe the other data point that I would reference in regards to kind of the speed and to put it in perspective is everybody thinks about 1987 and Black Monday in terms of the speed of that sell-off from a market perspective. The market was down roughly around the same, about 35% during that period, but it took 71 days. So it took 3 times longer in 87, which again, historically, everybody thinks of 87 as kind of the worst case scenario for how quickly markets can go down. This just, again, puts that in perspective of how different the speed was this time. And again, that I would say that goes back to how quickly things changed globally around kind of the economic system that we operate under, and just how quickly things shut down with this pandemic, obviously being really different than anything we've ever seen historically from a global economy standpoint.
So, Austin, this is Rusty. One of the things that we've spoken a lot about on our investment committee meetings is the government's phase 3 program, the $2.2 trillion relief package. How do, for our listeners, could you tell them a little bit about how we see that affecting the markets?
Yeah, no, absolutely. I think the government stimulus is really important for a number of reasons. And what I would tell you is obviously a lot of the headlines center around the individual payments, the $1,200 that are going out to the individuals, and not to suggest that that's not important. But in the grand scheme of things, I think the portion of the stimulus package that's probably most important is going to be that portion that focuses on small business. And the reason that I would say that is if you think about really the impact or the importance of small business in the U.S. economy, I don't think you can understate just that level of importance. And those programs that are being put in place with, Rusty, you mentioned phase 3, but I would argue really all of the government stimulus. It's important to understand just how crucial to the U.S. economy that small business is. And what I would tell you is there's really, trillions of dollars of wealth in the U.S. tied to small business. And unfortunately, small businesses financially really aren't set up to withstand global economic shutdowns. We saw a chart put out just recently that would suggest that roughly 50% of small businesses have less than 3 months of cash or liquidity reserves, if you will, cash on hand to be able to continue operations in the midst of a shutdown like this. And I think there are lots of reasons that small businesses don't hold cash from a tax perspective. So not to suggest that they're being irresponsible by any stretch, because it's not really in their best interest to hold cash. But unfortunately, that the flip side of that is it makes it very difficult to sustain operations in this type of downturn. And that's why I would say that piece of the stimulus package is probably most important, is really getting that money into the hands of small business owners so that they can, more than anything, just sustain operations, that they're not forced to shut down. Because I think the risk is if we're, let's say things start to reopen, this month, next month, and we came back to an economy where 20, 30, 40% of small businesses had been forced really to go out of business. And if that were the case, it would be a very different economic recovery picture than if the government stimulus is able to kind of step in and really allow them to, again, sustain operations during this period. So that's really what we're watching for. And I think that's one of the most important parts around some of those stimulus packages that have come out, is just the ability to keep the economy positioned for a recovery when lockdown and stay-at-home orders start to roll off here in the coming weeks.
And that's kind of what's different about now versus 08, correct? I mean, 08, the Fed didn't act as quickly as it did this time, right?
Yeah, no, I think, Will, you're absolutely right. That's another difference from 2008, that you have seen the speed that money has come into the system, both the markets, but also the stimulus packages. But another piece to think about is 2008, the structure that was breaking down was really the financial system. It was the big banks that were coming under pressure. And what I would tell you is that the stimulus monies that were being put to work then, the government actually had a really, I won't say easy avenue, but they had an avenue to fund those larger companies, those bigger banks. Up until, a month and a half ago, the government didn't really have a great way to get money into the hands of small business owners. And again, we can make comments about political differences all day, but I would tell you that the government as a whole did a pretty phenomenal job of getting money and making that available on a fairly rapid fashion relative to what they've done historically. Now, again, we can argue over whether it should have happened in 2 weeks as opposed to 4 weeks. But again, Will, to your point, if you look back to 2008 as an example, that's a package that took months to come together. Whereas this time they were actually able to come to the plate over the course of a couple weeks.
So Austin, thank you for that. Another question that's been on our minds and that we talked about is bonds. And recently the press reported significant stresses in the bond market. Can you talk a little bit about that?
Yeah, no, I think that's something that maybe got, like you said, a little bit of press. Maybe it's been overshadowed in some areas, but I think that was part of the reason that you saw market volatility the way that we did in the month of March. Really what happened in the bond market, and specifically the U.S. Treasury bond market. Again, I hesitate to use the word unprecedented, but it had never happened before, in that you started to see U.S. Treasury markets, in a sense, kind of break down. And why that's important is because the U.S. Treasury market is really seen as the safest asset around the world. That's where global markets go to. They kind of the safe haven asset, if you will. If there's fear of risk, oftentimes folks will buy U.S. Treasuries, and the breakdown of that market was important. And what I mean by breakdown is this idea that when you go to a market to buy things, and specifically it can be equities, it can be fixed income, bonds. Rusty, to your point, generally there will be somebody looking to buy and somebody looking to sell, and what that means is you actually create a market. That's obviously where the name comes from, and what that means is somebody's willing to sell it at a certain price, somebody's willing to buy that asset at a certain price, and oftentimes you'll meet in the middle in terms of what the agreed upon price is, and that's kind of where you get this idea of value of an asset. What I would tell you in the bond market is you had so many people coming into the market, but with such wide ranges, going back to that idea of uncertainty, really not knowing where to price certain pieces and what to even say that they would be willing to buy an asset for, specifically a U.S. Treasury, or what they'd be willing to sell it for. And you had this dispersion, or this really, really wide range. You had no kind of liquidity of that market because of how wide that range is between what folks were willing to pay for it and what folks wanted to get when they were selling it. So this breakdown of the market, in a sense, really required the Federal Reserve to step in and serve as that liquidity backstop. So to be a buyer of assets when folks were wanting to sell. And that was something that, again, you got to think about the U.S. Treasury market as that safe haven asset. If you can't price a U.S. Treasury, then unfortunately it becomes very hard to price any other asset class or any other asset in the market. So it's super important to understand that. Again, it's a little bit into the weeds in regards to the nuances of that, but that's really what you saw in March. And again, not something that we'd really seen historically, but comes from that uncertainty and just some of the wild range of expectations that you were getting, because folks really weren't fully understanding kind of how to grapple with the data that was coming out around the virus and then the impact on the economies therein.
Sure. So would you say that, first of all, that are bonds safe? And then beyond that, what would you say from your perspective about the bond markets now and our perspective as we move forward with our portfolios?
Yeah, no, absolutely. So what I would say is I think the Fed did exactly what you would expect and you would hope it would do in that type of event. It came in and kind of, again, served as that backstop, if you will, that buyer of last resort, if you want to think of it that way. And again, that I think highlights how well the system did work in the month of March, albeit in a very stressed time. So I would reiterate that, yes, bonds are safe. And the fact that the Federal Reserve was able to step in and really serve the purpose that it's called to do, I think is encouraging to that extent. What I would tell you going forward is in bond markets just more generally is you have to be, and I know we've talked about this at the investment committee level, you have to be understanding of the risks that are in the bond market today. We talked about government bonds maybe being a little bit safer assets relative to others. And I think that's the conversation that we've had is when you look at maybe more corporate bonds, or if you think about bonds that maybe provide a higher yield or a higher payment that would come off of those bonds, you have to understand the risk that's associated with that and the potential for volatility associated with that. And I think that's really important as you're looking at a fixed income portion or a bond portion of a portfolio, is to make sure that you're balancing the risks and the volatility therein with the potential benefits of maybe getting a slightly higher yield off that asset class, knowing that there's a trade-off there.
Thank you very much. I'm going to kind of switch gears here, Austin, and I'm going to ask you a couple of questions at once.
Yeah.
You know, can you make some sense of what happened with the oil market and oil prices and the effect it's going to have on markets globally? And secondly, what does it mean when you hear the price on a barrel of oil is negative? How is that possible, right?
Yeah, no, that's a great question, Steve, and one that I know we've gotten from a number of folks, and I know we've talked about just kind of the dynamics of what that means and what that looks like. And what I would tell you is just maybe taking a step back, and we talked about maybe some of the risk coming into at the beginning of 2020 around oil. Obviously, you had a shock to the supply side, meaning that basically Russia and OPEC were at the negotiating table at the beginning of March and did not come to an agreement. They basically left the negotiating table and said, we're both going to pump as much oil as we want. We're not going to acquiesce to the other's desires in any way, shape, or form. So coming into this global pandemic, you actually had an oversupply of oil. Couple that with the fact that then you enter a global pandemic where basically the global economy, you've had this kind of rolling shutdown of the global economy. As obviously it started in China, it spread to Europe, and then obviously it's in the US as we speak. So you had this oversupply coupled with about 3 or 4 weeks later, you started to see really pretty significant demand cuts, and that you didn't need oil if economic activity was down 60, 70, 80% from normal. So the combination of those two factors, more oil available than anybody could really need, less oil really being desired or requested than historically would even be anywhere near normal. Couple that with the fact that you had this technical piece of oil markets pop up in the month of April, and that led to kind of this negative oil price. And what I would tell you is the way that they price oil is on what's called futures contracts. And all that really means is it allows for somebody to lock in the price of oil that they're going to get at a certain point in the future, knowing that, for example, if you're going to buy the May futures contract, you could pay a certain amount today, and then you would receive delivery of that barrel of oil when that contract comes up, or what they call expires. So what happened in the month of April is you had all these people buying these barrels of oil futures contracts. And again, that just meant that I think it was April the 23rd when that day happened, that at the end of that day, folks would receive their oil. What you found was that folks, in essence, didn't want the oil that they had already agreed to take. And that's really how you kind of got this idea of negative oil prices. So you had an oversupply, an under demand, if you will, and then with the thought being that the folks that owned those contracts and were set to receive oil didn't really have a place to put it. And in essence, what they did was they were going out to the market and they were telling people, I'm willing to pay you to take the oil that I'm set to receive off my hands. And that's how you get a negative oil price, is no longer are you paying to buy the oil, now you're paying somebody to take the oil from you. And that's what happened. Again, it was a confluence of events. It really hit, again, late April, as you were really in the thick of it from a U.S. economy perspective in regards to the demand shock that we were seeing. The supply shock obviously is still occurring. So that all happened right around the end of April. It potentially could happen as we get towards the end of May again. Obviously, the hope is that demand is starting to pick back up to offset that. But I think it's kind of it's up in the air as to whether or not you'll see that dynamic play out again. But it really just highlights the lack of demand for oil that's in the marketplace today. And what I would tell you is why that's important is it just hints at that lack of economic activity that we're hoping to see start to pick back up. But you really haven't seen that yet. And I think oil is a good proxy for economic activity in a sense.
So Austin, I guess, it kind of leads into, a question we get all the time is, are we in a recession? Are we going to be in a recession? And, what's the depth, the length, how long will this recession last? And I know if you ask myself, if you ask Rusty, if you ask Steve, you're probably gonna get 3 different answers, right? And I know we talk about that a lot on our investment committee calls. So kind of, I guess, bounce off ideas that we all, see in regards to what a recession might consist of.
Yeah, no, absolutely. So I would just maybe I would tell everybody on the call that the technical definition of a recession is 2 consecutive quarters of a shrinking economy. So growth being negative, if you want to think of it that way. And I think technically, yes, we are probably right in the midst of a recession. And the reason I say that is obviously you had first quarter GDP growth come out negative. And we're, I would say, more than likely going to see GDP growth negative in the second quarter. So technically, yes, I think it's fair to make the statement that we are in a recession today. I think the question of the length of that recession is really maybe the one that we've talked about probably most. And I think it depends on a couple different things in regards to the virus itself. I think if you start to see these shelter in place and stay at home orders roll off, which we've started to see over the last week and a half now, and there's really not maybe a risk of a potential second wave. If really the economy slowly starts to pick back up, I think you would experience probably a shorter recession, maybe 2, maybe 3 quarters, and realistically start to see positive growth as we get into the latter half of 2020. The risk, as kind of we talked about earlier, is this idea of, if you get a second wave, or if you get maybe not so great news around a treatment or a vaccine. What I would tell you is, and I know we've talked, that there are probably no less than 20 pharmaceutical companies working on some sort of treatment plan or vaccine, which, just to put that in perspective, is historical in its own right. Just the number of companies working on a single solution to a single problem, in essence. But I think the risk is that all of those kind of fall flat. And again, if you have that, then you probably start to have a second wave of shutdowns, which then really, in essence, kind of exponentially lengthens that recession. So what I would tell you is that you could very easily, if, for example, if you got a vaccine that came out next week and they said, hey, this is going to maybe not eliminate the virus, tomorrow, but it's going to make it something that allows us to go back to some semblance of normalcy. If you had that, then what I would tell you is that recession would probably be on the shorter side. The other end of that is if you have the risk of a second wave, or if you see another round of kind of economic shutdown orders go into place, you could very easily see that continue into 2021 from an economic impact standpoint.
Gotcha. All right. And so obviously when you have a market pullback of 35%, there's going to be sectors or segments of the stock market where there seems to be maybe some, that are interesting because you think maybe that's where we should look to invest some dollars and whatnot because there's opportunity there, right? So where are some of the opportunities that we've discussed in our quarterly calls coming from?
Yeah, no, and I think you bring up a great point in terms of there are definitely segments of the market that offer more favorable outlooks than others. We talked earlier, actually at the very beginning, we talked about the NASDAQ, that being an index that focuses on technology and some healthcare companies. And that's important to understand really what types of companies have been most affected by the economic shutdown, and maybe what companies have not been affected, or in some cases have unfortunately benefited from this type of shutdown. And what I would tell you is the technology and healthcare companies, both on the way down, have outperformed, but also offer probably better opportunity on the way back in, at least in the shorter term. And when I say shorter term, I'm talking probably 3 to 6 months. And I know we've talked about time frame for reinvestment in regards to the portfolios. So I think it's really interesting, or really important to understand kind of that time frame component. Whereas, where a technology company, like I said, this Zoom technology is a perfect example. So that's a technology that coming into this year, folks used occasionally for work meetings, for conference calls, for calls very similar to what we're doing here today. But it wasn't it wasn't broadly used. I think you've seen the explosion of certain types of digital solutions to problems or to handle things that we otherwise normally would have done in person, that we haven't been able to do in person. And I think that only continues as we come out of this in terms of the transition or the digitalization, if you will. Amazon is another great example. They came out and basically said that they're not expecting to see really any hit to kind of top line revenues. In actuality, they may see a boost. And again, that makes sense if you think about it, that while I think we all realize that a lot of people order stuff from Amazon on a daily basis, that has only ramped up over the course of the last month or so. So again, in this type of environment, there are certain companies that benefit. There are other companies that I mentioned earlier that maybe are going to be harder hit. Your restaurants, your hotels, we call those discretionary items, and those are items that in essence would be non-essential, if you want to maybe put it in kind of government terms these days. And those would be areas of continued risk until we start to have some level of certainty around what an economic recovery looks like. Now, I would tell you, as we get further out, maybe as we get into early 2021, we do think there's opportunity in certain segments of markets that have maybe been unfairly sold off, or maybe they've been oversold in a sense on the downside. If you want to think about your industrial material types of companies, your building services, if you will, where you started to see a slowdown there. You talk about the restaurants and the hotels, the consumer side of things. As you ramp back up and as the economy does pick back up, there's absolutely some opportunity there. But again, you do have to have more clarity around what that looks like than realistically we have today.
Shifting from specific sectors or things that we're looking at right now from a stock market standpoint to more of a bigger picture, global versus domestic investment opportunities. What would your thoughts be on that?
Yeah, no, Rusty, I know we've had this conversation a couple times as well. I think it's really important to really think through the effects of something like a global pandemic on an economy, on an individual economy. And I think that's important to look at some of those economies, as standalones in a sense, knowing that we are, yes, in a global economy that is interconnected, but there are certain regions and certain countries that stand to benefit a little bit more, not necessarily benefit, but maybe they're not going to be hurt as bad from an economic shutdown. And we've had this conversation internally around a country like China. Very rarely would you suggest that an authoritarian or totalitarian government is good for lots of things. I think that's probably fair to say, and I think we would all agree with that. One of the very few things maybe that it is beneficial for is the handling of this type of event. And the reason I say that is the ease with which a totalitarian government or an authoritarian government like China can, in essence, shut down their economy and then turn it back on. I won't say it's as easy as flipping a light switch, but it's not terribly far off. That's very different, obviously, than a country like the U.S., where obviously we're, fully bought into capitalism and see the benefits of that much longer term. Absolutely. But what I would tell you is some of those freedoms that we have in our current environment do make it a little bit more challenging from an economy standpoint in order to shut that down and reopen that back up. And you've seen that with some of the discussions around certain states reopening, other states maybe being slower to do so. So I would tell you that the U.S. Is by far not the worst in terms of the area, but it does offer a little bit more, a few more challenges relative to certain areas of the economy, those more developing countries. The last piece, and I would say this is kind of the other side of the spectrum from a country like China, would be in a region or an area like Europe. If you think about the European Union, it's almost think about kind of the economic discussions that are happening in the U.S. In Europe. That's the U.S. on steroids in a sense, because it's not just individual states having conversations about when to reopen and the economic impact. The European Union, you're talking 25, 30 countries that are trying to really wrestle with how to reopen the continent as a whole and the economic impact therein. So I would tell you that, and I know we've talked about the idea of probably leaning more domestically, potentially with a tilt towards certain maybe emerging or developing economies, but probably staying away from regions like Europe for the foreseeable future because of some of the risk associated with that type of economic structure and the challenges that you would face when opening up that type of economy that's kind of multi-country.
Well, I know we have touched on a lot of different data points today and a lot of things that we've talked about and a lot of questions our clients have talked about. As we wrap up today, I just want to let all of those of you that are listening, we want you to know how much we appreciate you taking the time to join us today. We're very fortunate to have a dedicated team who, over the last couple months, have continued to work from the office or have been working remotely to make sure that we're able to service all of your needs. As our state begins to open back up, we're continually monitoring the progress of that opening in hopes to get all of our staff to return back to the office, along with returning back to in-person meetings. I feel very fortunate we were able to do this call today. We would appreciate the feedback that you have from today's session. You can email or call any of our staff to let them know what your thoughts were, or you could email us at helpdesk@foothillswm.com. I'd like to say thank you very much to my partners, Steve and Will, along with Austin, to do the call today. And Josh, thank you for being on here as well. And also we had a lot of assistance from Danielle and Morgan in putting this call together. So I'd like to thank them. We hope that all of you continue to stay safe and healthy. And this concludes our call for today. Thank you all very much for joining us.
Thanks, guys.
Thanks, Rusty. Thanks, Steve. Thanks, Will.